listening to the Agent Survival Guide podcast, a podcast for today's insurance agents. Informing, educating, empowering, improving the way you do business in an industry that's anything but static. In today's episode, have you ever wondered if you should incorporate your insurance business? There are a lot of options when it comes to setting up your insurance business structure. And because of the legalities and tax implications involved in the process, we reached out to a local law firm for their advice. Frank Lavery and Justin Abodalo specialize in business law and tax law, respectively. Joining us here on the podcast today, we have Frank Lavery and Justin Abodalo. Welcome to the podcast.
Thank you for having us.
Now, it doesn't matter which one of you wants to go first, but if you can just give us your titles and kind of give us your area of focus and just a little bit about how you guys decided to get into your particular area of law.
Well, my name is Justin Abodalo. I'm of counsel with McNeese, Wallace & Nurek.
Okay.
I've been with the firm for about 3 years now. I specialize in federal income taxation. So I'm in the corporate and tax group with extra emphasis on the tax part. I sort of just happenstanced into it. I originally wanted to be a prosecutor going into law school. Took my first tax course, fell in love with the subject matter material, and that's how I got here today.
Okay. Yeah, you have a very interesting background. You've done some interesting work in more recent levels of the former administration. You have a very interesting resume.
Thank you.
All right, Frank, what about you?
Yeah, so my name's Frank Lavery. I'm an associate in the McNeese Corporate and Tax Group. I've been with the firm for just under 3 years at this point, and my emphasis is in mergers and acquisitions, so I leave the tax stuff to Justin. And similarly, I don't want to say that I fell into it because I was always attracted to the corporate law sphere and the transactional space. But when I was, finishing up law school, I kind of at that point figured I'd end up in litigation in some capacity. So I've been very fortunate to get to do what I originally wanted to do, which is the M&A work.
Okay. I feel like in our industry, a lot of people sort of fall into insurance, whether they are like me trying to leave a dying industry to get into one that is a little bit more stable, or whether it's just something that, a relative or a friend says, hey, come work for my firm. So that's interesting. But what we want to talk about today is just kind of going through some of those steps insurance agents need to take when they are creating their business, what that looks like, the different business designations that there are, and just the kind of things that agents should really be thinking about as they're going through that setup process. So I guess our first question here is, why should an insurance agent take that extra step to incorporate their business?
Sure. So I guess I kind of look at it, tax notwithstanding, in kind of two buckets. So on the business side, you really have three super beneficial aspects of incorporation or registering your business entity, whether as a corp or an LLC. The first, as I see it, is increased reputation and credibility. So here, it's sort of intuitive, but people prefer to do business with registered business entities.
Mm-hmm.
You think of if you're buying a cell phone, you want to buy it from Apple. You don't want to buy it from Tim Cook. The next one I think of is your access to capital, and this kind of comes in two ways. One, you can raise capital by bringing in new partners, shareholders, or members to your LLC. And sort of touching back on the increased credibility, it's easier to get a bank loan. Banks are much more comfortable lending to registered business entities because you have the assets of the business entity to secure any loan proceeds you get. The third business reason that I think is important is limited anonymity. What I mean by this is that when you do business as a registered business entity, the company becomes the face, and that's what people see outwardly in the public sphere. So while you may be a sole owner and running the scene, or running the business behind the scenes rather, what people see is your business entity. And then on the legal side of things, I think the biggest benefit to registering a business entity is your insulation from liability through something known as the corporate veil, which I'm sure we'll talk about in more detail later.
Okay. See, and this is why we have you guys come on who are experts in this field, because there are reasons that you just gave that are reasons that I would never have even have thought of or come up with. So let's maybe get into some of those different types of business entities. You mentioned a few of them. We'll kind of go down the list here and we'll get into some of those definitions and things just in case you're hearing, LLC and wondering what that is. We will get into that, I promise. So let's maybe start out with the sole proprietorship. What does that look like when we are setting that up, and why would we maybe want to do that?
Yeah, so the sole proprietorship it's really the default choice almost for anyone running a business that hasn't set up any other type of formal business entity by registering with the state. In Pennsylvania, a sole proprietorship or a sole prop doesn't actually require the filing of any formation documents, and that's sort of unique as compared to other business entity structures. And ultimately, I think one of the biggest benefits of the sole prop is ultimate flexibility, because it's just you ultimately that's doing business. By default, sole proprietorships are in the name of the sole proprietor. So I would be, my sole proprietorship would be Frank Lavery. Oftentimes, and this goes back to what I had mentioned on the credibility point, you can register for a fictitious name where, again, you don't become a registered business entity by filing and obtaining a fictitious name or a DBA. Mm-hmm. But that is one way that you can sort of create almost an alter ego for the sole proprietorship. And again, the big benefit of the sole prop structure is that you have really, really almost unlimited flexibility in how you want to conduct your business affairs. On the business/legal side, the biggest downside is that you don't get any of the liability protections of a registered business entity. So again, we will get into a lot more detail, but you don't have that corporate veil protection, which means that if you have a liability that needs satisfied, whether by way of a lawsuit or some sort of judgment against you, your personal assets are on the line, as opposed to just the assets of the business.
Okay.
And of course, there are tax implications.
No, I don't think we need to stress to this audience the importance of risk mitigation. But I would say the only benefit to maintaining your business as a sole proprietorship for tax reasons would be just the simplicity relatively, as opposed to having an S corporation or a partnership where you'd need to file a separate return for the entity every year. It's just your individual tax return from year to year.
Okay. And how does that go? And it's okay if you haven't ever seen this, but I'm curious, does that get messy for the person filing those taxes if they have to, okay, this is one person filing, but there's business expenses, there's personal expenses. Yes, they do need to be in different bank accounts, but how does that go on the tax side as far as keeping them straight?
So as you can imagine, it does get very messy, and organization is key. So it's, to your point, having a separate checking account, a separate savings account, all of those things, even a separate credit card to an extent. The more you have a delineation or a separation of church and state, if you will, the better. Organization is key, and, heaven forbid the IRS ever comes knocking on your door and you need to defend yourself in an audit. If you have organized documents teed up and you can hand them readily available, so much the better for you, and to get through the process that much more quickly.
Right. Well, let's go on to our next designation here, our next type of entity where I think we might find more of our agents listening in this bucket, if you will. What does it look like when you have a partnership? What does that look like?
Yeah, so a true partnership is really formed almost de facto when two people start doing business together. Similar to the sole prop, you don't need to file any sort of articles or certificates with the Commonwealth or any state, at least to my knowledge, to actually form that partnership. So again, you have the benefit of ease of formation and flexibility. On the paper trail side, I do think it's important to note that you should really consider, if you're going to go down the partnership route, drafting or having someone draft for you and then executing a partnership agreement that would sort of lay out the governance of the partnership and in particular distribution of profits. So the default rule for partnerships in Pennsylvania is that profits are distributed equally among the partners. But as we know, not all partners are equal. You will see varying degrees of contributions to the partnership. And if you want, for example, to have profits and other benefits distributed in accordance with the actual contributions made by the partner, that needs to be set forth in the partnership agreement. And that really applies to any sort of non-equal distribution of profits. Another big thing is that, like the sole prop, the partnership, while very easy to form as far as, paperwork that needs to be submitted, you don't have that corporate veil again. You don't get the liability insulation. So the assets of not just the partnership, but also of the partners is on the line to satisfy liabilities. And in addition, just so I don't misspeak, I should note that as with partnerships, sole props, this applies to as well. I don't want to imply that there's no paper trail that you need to worry about. There's obviously licensing and permitting requirements that you need to comply with, but that's almost more on an industry-specific level. So you don't need to file anything with the Secretary of State to form those sort of entities.
Right. No, we appreciate that. We do try to lay out as much compliance information as we possibly can. Justin, I can only imagine how taxes get a little more complicated once you have a partnership without any type of corporation or any of those kind of articles of basically how you're going to do business and how the business is set up.
So all of that simplicity with the sole proprietorship goes out the window when you get into the partnership universe. And to Frank's point, you can have a de facto partnership. And I think it's important to, because there are different types of partnerships too, right? You have your limited partnerships, your limited liability partnerships, general partnerships. So the more you take dominion or control, and if you're a contact player, to write the rules of what the agreement is between you and your fellow partners, so you don't get kicked into the default statutory rules. So the more you hold the pen, it is a little more advantageous for you from that perspective. Partnerships, they have a lot of benefits, but when you get more granular, they are some of the most dense Treasury regulations that you are working with. And there are a lot of traps for the unwary. So a go-to example for this is, suppose Frank and I are already in a partnership and we have a $30,000 mortgage. Enter Sarah, who comes in as a partner. By virtue of you becoming a third partner in our partnership, we're deemed to receive $10,000. And so having that deemed cash distribution, even though we haven't received the cash in hand to pay the tax liability, sometimes it gets a little tricky.
Okay.
That and other considerations for the Bipartisan Budget Act back in 2015 raises all these different considerations. And like I said, just a lot of traps for the unwary that you want somebody who's seasoned. And because those Treasury regulations are so dense, if you are going to go towards the partnership route, it's perfectly fine. But you want a CPA or other professional who's well-versed in those regulations and who can help you spot those traps.
Okay. That's some wise advice, I think. Next, we'll get into one that we mentioned previously, the LLC, which stands for the Limited Liability Company. I feel like this is one of the most familiar to people when they hear about, creating a business. It's like, oh, you want to get your LLC because then you'll be shielded from, any liability that may come at you. But what does that actually mean when we have an LLC? What exactly are we shielded from, and what are we entitled to when we have that set up?
So the LLC, this is the first registered business entity structure that we've discussed so far. So what I mean by that is you form the LLC by submitting to the Secretary of State in Pennsylvania, and in any other state really, what's known as either a certificate of organization or a certificate of formation usually. And that forms the basis of you actually being registered with the state. So differentiate that from your sole proprietorship where you can just go start doing business. This kind of puts you on notice with the state or rather puts the state on notice that you are registered and doing business as an organized entity in that state. As you sort of alluded to, the LLC is a really big favorite of new and small business owners because the LLC offers remarkable flexibility in its management. So an LLC is generally, it's not required, it's typically recommended that you execute an operating agreement between the company and the owners of that company, which in the LLC space, they're known as members. And in that operating agreement, again, you really get a lot of flexibility with how you govern the LLC. So one big example that I always think of is you can have a member-managed LLC, which is where the owners themselves conduct the day-to-day management activities of the company. You can also have a manager-managed LLC, which is where the members appoint certain managers who may or may not also be members, but then those managers really take over the operation of the company. They make a lot of the major decisions. Of course, again, speaking to the flexibility, you can also curb that a little bit in the operating agreement. You can reserve certain decisions, crucial ones like disposition of large portions of assets or equity to the consent of the actual members. So again, I think a huge benefit is the flexibility, but also, as I promised, this is where we get into the corporate veil. And really what that means, and this is where you get the limited liability, that limitation of liability comes from the corporate veil. And what that is essentially is a corporate legal fiction where we take the owner, even if it's multiple. So if Justin and I are both members in an LLC, we're kind of behind this shroud, the veil that is. And then front-facing to everyone is the actual LLC. And then if there's liabilities of the LLC, it's only the assets of the company that can be gathered to satisfy those liabilities, whereas Justin and my own personal assets are off the table for purposes of satisfying debts, judgments, or any other liability of the company itself. So it's important when we talk about the corporate veil, though, to understand that you can lose that protection. And there is a strong presumption in favor of the corporate or LLC form, not just in Pennsylvania, but really across the country. I believe that's Supreme Court precedent. And there's a wealth of case law that gets into a lot of the nitty-gritty of the corporate veil jurisprudence. But generally, maintaining the protection of the corporate veil goes to observing formalities typical of your business entity. You want to make sure that you do have an operating agreement, that you're adequately capitalized, that you're adequately insured, which is important. And really, all of this goes toward the purpose of the veil, which is to make the company distinct from its owner. If the company is effectively just an alter ego of its owner, then that's where courts will pierce the corporate veil and go through it to the assets of its owner. So, again, the big factors where you'll see courts set aside the presumption in favor of the corporate form is in instances where the entity is being used to conduct fraud or manifest injustice towards the public, failure to observe those basic formalities, keeping meeting minutes, acting by resolution, things like that. Undercapitalization, if you intentionally don't put enough money into it that it can satisfy its ordinary course liabilities, then a court is going to take issue with that, or might, at least. And a big one that we have a lot of case law on is commingling of funds. So Justin kind of talked about this earlier. You really want to make sure that you go to lengths and make sure that your company, corporate, LLC assets are separate and distinct from your personal assets. And that might seem intuitive depending on the size of the business you're talking about. But if you're a single member LLC, you can be tempted to look past those formalities for ease of operation. But when you do that, you really risk losing the biggest benefit of the LLC, which is the protection from personal liability for business losses.
Right. And I should probably point out that that is something that when we become licensed as agents and even just CMS compliance, that is actually required. Whether or not, as you said, it may seem tempting to, just put it on this card for now, we'll reconcile it later. we should not be doing that because that is against CMS compliance. So, yeah.
Absolutely. It's important to maintain that the company is not the alter ego of the owners. And piggybacking more off of the corporate veil, to Frank's point, there's a plethora of jurisprudence touching on this, but what's somewhat new in Pennsylvania is the takeoff of the enterprise theory with the Mortimer v. McCool case back in 2021 with the Supreme Court saying for years you could pierce the corporate veil up, you could pierce it down, but you could never pierce it side to side to brother-sister entities. That all changed with the McCool case. I remember when I was younger, a friend had a little accident with a taxi cab in New York, and I joked with them saying, "Oh, you're going to be rich. That's NYC Taxi." And they said, no. It turns out they insulated themselves where each cab had its own LLC, and the sole asset of each LLC was the taxi cab to mitigate the risk. So as if there was an accident for one taxi cab, they couldn't go after the whole company. So.
Interesting. Wow.
But I guess pivoting to the tax side of things, LLCs are interesting in the sense that they can be whatever you want. That sounds odd saying it out loud, but so you can file what's called a check-the-box election. So a default treatment for an LLC if it's owned by a single person, and when I say person, I don't mean just warm-bodied individuals, but other entities as well. It's the shorthand that I use is a DRE, and this is a mouthful, so bear with me. It's a disregarded entity, meaning solely for U.S. federal income tax purposes, the entity is disregarded as separate from its owner. So say, for instance, if you have an LLC and you're the only owner, as far as the IRS is concerned, Sarah and the LLC are one and the same. And all of the activities of the LLC would just get reported on your individual 1040.
Okay.
If Frank and Justin come into the picture as partners in the LLC, then it automatically springs to a partnership for tax purposes. Again, solely a tax fiction. It's still an LLC for legal purposes, but now going forward, it's going to be a partnership, and it's going to have to file its own Form 1065 on an annual basis. You could still check the box. After President Trump passed the Tax Cuts and Jobs Act in 2017, lowering the corporate tax rate, which we'll discuss more later, a lot of clients were interested in going from partnership to C corporation solution because of these lower rates. So a lot of them just simply checked the box, filed what's called Form 8832 to choose what type of entity you're going to be for tax purposes, and overnight became from a partnership to a corporation.
Okay.
And they can also be S corporations as well. But again, just a trap for the unwary is there are these deemed transactions that occur. Again, purely tax fictions. But these are things that you want to be cognizant of and keep in the back of your head so you don't trigger any phantom income for yourself.
Now, you say tax fictions. What do you mean when you say tax fictions?
Okay. So suppose we have an LLC that checked the box and converted from a partnership to a corporation. What was once a partnership for tax purposes is deemed to contribute all of its assets and liabilities to the new corporation in exchange for the corporation's stock to the members of the LLC. And where it gets tricky and where you can trigger some deemed income for yourself is, and this is just one example, suppose the liabilities are greater than your tax basis in the assets. Say I had a $500,000 liability with a $300,000 tax basis. If I contributed that to a corporation, then that would trigger a $200,000 distribution to me of sorts. And I would owe tax on that phantom $200,000.
Gotcha. Okay.
Yep.
That is one thing that we are not exactly familiar with. So thank you for defining that and giving us an example.
And the inverse of that is if you convert a corporation to a partnership, the corporation is deemed to distribute all of its assets and liabilities up as well. So you have that deemed distribution, which could trigger a significant tax liability for you. So,
okay.
One other point on the business side, because I feel like I just sung the praises of the LLC a lot. And in all seriousness, a lot of new business owners, people considering starting registered business entities, do find the LLC to be ideal for them. And there are certainly a lot of reasons why. Again, there's a lot of flexibility there. But sort of piggybacking on Justin, that tax status election, that can kind of curb some of that flexibility. So, for example, if you elect S-Corp status for tax purposes, you are bound by certain S corporation requirements, which we'll get into in a little more detail. But I do think that is something to point out, that while you do have a lot of freedom with the LLC, depending on what tax status you elect, you might have to pay attention to some of those more specific requirements for your tax election.
Okay. These are good things to think about. And I think that's what we're trying to establish here, is really that you want to know about all of your options and be well educated up front. At least that's what we're hoping to do here, so that you can make the best choice possible when you are, in fact, setting up your insurance business or your insurance agency. Did we cover everything as far as the tax benefits on the LLC side that you can think of?
I think so. And again, you have to be nimble in that analysis, because an LLC, it could be an S Corp, it could be a C Corp, It could be a DRE or a partnership. And so in the deal space, when we are diligencing a target entity that is an LLC, sometimes I come across like a dog with a bone, but I really want to confirm what they are for tax purposes, because it dictates the flow of the entire analysis.
Gotcha. Okay, well, let's move on to our corporation side of things with the C Corp. What is the definition of this particular entity and what's required here?
So the C Corporation, as compared to the S Corp that we'll get to in a little bit, I think of as kind of like the big brother. So it is formed by the submission of articles of incorporation to the Secretary of State's office. You know, I think a lot of smaller businesses typically don't find that the C Corp is the best structure for them. However, I should say, and really this applies for all the entity structures we have discussed and will be discussing, you should definitely check your local listings, because mileage may vary on a lot of these things. And depending on, the very esoteric things that you are focusing on, this general overview might not necessarily be applicable. So I always recommend that when you're deciding what entity structure to go with, you should definitely consult with someone who's familiar with business counseling and certainly tax consequences as well when you decide. I think with the C Corporation, again, you get the protection of shareholder assets from company liabilities through the corporate veil. So again, that is pretty much going to be a consistent benefit of all of the business structures we'll keep talking about. But one thing with the C Corp, they're typically larger than S Corps. You do sort of have a little bit more freedom. So there aren't limits on the number or type of shareholders. Pretty much anyone can own a C Corp. I can't think of any limitations on that.
Yeah. So to be a valid S Corporation, you have to have valid shareholders. And to Frank's point, they need to be certain types of trusts, U.S. citizens or residents, and you don't see it that often, but nonprofits as well can be a S Corporation shareholder.
Okay.
So again, that ownership freedom really gives you almost unfettered growth for what you might see going forward. Another big benefit of the C Corp structure, and this can really matter, I think, when you're getting started and you're looking into raising capital, you have the option of preferred stock. So you don't need to worry about certain rules that I'm sure we'll talk about shortly about how distributions are made. You can have stock where even though you didn't put in as much capital, you can receive a preferred return on that investment. And of course, as I mentioned earlier, you get that liability protection, which is often at the forefront when I think you form businesses, and then you kind of forget about it until you need it, and then everyone's very grateful to have it. Some drawbacks to the C Corp. Again, I think the biggest one Justin will probably talk about on the tax side, but from a business side is they have more oversight and regulation, I think, than S corporations see typically. There are certain requirements that are consistent with all corporations that you don't see, for example, with the LLC. Like one example is that any corporation in Pennsylvania needs to have a president, secretary, and treasurer. And if you are a sole shareholder of a corporation, you're all three. Usually, that's how it ends up being. You can appoint officers that are not shareholders, of course, but again, that's sort of one of those check-the-box type things that doesn't really make a lot of sense, but you have to observe those formalities in order to maintain the protection of the corporation, which is ultimately, I think, the biggest legal reason aside from taxes, that you want to register a business entity. But as I said, I think the biggest drawback there is the tax side.
Yeah, and I think in addition to the tax, so with a LLC versus a corporation, the LLC kind of allows you to tailor the operating agreement more to the business needs, whereas, you do have those formalities, I'd call them, with a corporation that you need to adhere to. But as Frank alluded to, with the C corporation, you have the 20% entity level tax off the bat, which is pretty disheartening to some people when trying to start up a business. But on the flip side of that, there is something called qualified small business shares, where if you are a C corporation and if you check all these certain boxes, you can multiply your tax basis depending on when you acquired the shares, sometimes 5, sometimes even 10. So say if I have a $200,000 tax basis in these shares and I sell them, my basis increases from 200 to 1 million or even 2 million. You don't really see it that often. But from a practical standpoint, you would want to prefer the pass-through treatment, because even in addition to the entity level tax, when the corporation does repatriate or make a dividend out to the shareholders themselves are also taxed when receiving that. And it's not straightforward as you would think. You have to run through this different waterfall where first you have to calculate the E&P, and then after you exhaust the E&P, you apply it against your basis, and then only until after you exhaust your tax basis in the shares, then do you determine what your tax liability will be on that dividend. So complex, some pros. It does offer you diversity in the sense of if you are being acquisitive. So within the past couple of years, with the interest rates being as high as they have been compared to what we've seen beforehand, and banks not being as willing to finance acquisitions as readily as before, a lot of clients are getting creative in the sense that instead of offering cash up front, if they can't secure the financing, they'll provide stock. And so if you have C Corp stock, and if you pass certain thresholds and satisfy certain other judicial and statutory requirements, if you structure it as a merger, I use that term, it could still be a sale on paper in the purchase agreement, but if you treat it as a merger for tax purposes, you can have some of the transaction qualify as tax deferred.
Okay. So when you said that you don't typically see this with a smaller business, do you see more businesses going with the S Corp designation typically if they are not choosing the LLC? And what would make a small business, I guess, choose that designation over the LLC?
So I can't speak for like a representative national observation. But yeah, I would say in my experience, the S Corp is certainly more popular than the C Corp for smaller businesses. Again, a lot of tax implications that just are easier, I guess, to swallow when you're a much larger corporation, whether by, just the need for how many shareholders you have. So with S Corps, you're limited to 100 shareholders. So that can stifle growth at a certain point. Again, I wouldn't say you see that issue frequently with small businesses because, 100 people, picture it in a room, that's a lot. So I don't know that that's something you'll inherently run into if you go with the S Corp, that you'll outgrow it, so to speak. But for some businesses, that is a consideration that they have to make. And I think going back to the LLC, the reasons I think you would go with the S corporation by filing articles of incorporation as opposed to an LLC with an S corporation tax status election, I would think the reason you would lean more towards the LLC, again, would be the flexibility that you can have there, dictating management decisions through your operating agreement. But again, as I also discussed briefly earlier on, once you make that election for S corp status, as an LLC, you are bound by S corporation rules. So one of the big ones with the S corp is that distributions of profit, dividends, they need to be paid in accordance with your ownership percentage of the company. There is no allowance for preferred stock in an S corporation. I should say you can have voting and non-voting shares, which is sort of a workaround sometimes, if you want to bring in somebody to raise capital, but you don't want to actually have them making decisions for the business. You can issue them non-voting shares, which, again, you have to pay them in proportion to their contribution and ownership interest, but it is a bit of a workaround on the side of flexibility of management of your business.
And so, to confirm, an LLC can be an S corporation for tax purposes.
Yes.
And I think, as Frank was saying, the rule is no disproportionate distributions. We're kind of returning to our example where if we have an LLC with Sarah, Frank, and Justin, and Sarah and Frank contributed $10,000 of capital and Justin's only contributing sweat equity, we can't have a disproportionate distribution to make Sarah and Frank whole more quickly. If there's $1 million earned in the first year, $333,000 needs to go out equally to each of us. So, whereas with a partnership for tax purposes, again, you have more nimbleness, you have more dominion over how you want. You can have the distribution waterfall tailored as much as you'd like to. So that's one of the benefits. And I guess a con in the partnership column is no relief on the self-employment taxes, whereas for an S corporation, if you're a shareholder and an employee, you do get a little bit of relief on the self-employment tax, so as long as you are giving yourself some sort of a reasonable salary. So.
Okay.
Another big difference with the S Corp and why a smaller business might go with a C Corp over an S Corp, domestic persons are the only permissible shareholders in an S Corporation. So if there's any foreign ownership in your company, you would need to elect that C Corp structure.
Okay.
And another big drawback, Justin kind of touched on it earlier actually, when you're looking with an eye towards diligence at a company, making sure that they've properly maintained their S election is really important, because if you make a mistake and you make disproportionate distributions of profit, you blow your S election and then you default back to a C Corp, which again then opens you up to all of those tax implications. So S corporations, very attractive for a lot of smaller businesses. As you get bigger, making sure you're maintaining those requirements and formalities becomes more and more important, although it's something most people are already keeping an eye on anyway. But I think the biggest drawback of the S Corp is that if you lose it, it's a real headache. Yeah. From the legal side, at least.
Oh, yeah. Yeah, and you're talking about a potential liability that could possibly bankrupt some companies. Okay. I mean, if suppose you formed your S corporation in 2020 and you unknowingly compromised your S corporation status and you were actually a C corporation for the past 5 years. And just to keep things simple in this example, say you're earning $100,000 a year, you're talking about $20,000 that you owed at the entity level for each year as a C corporation, on top of the interest and on top of the penalties. So it racks up very quickly, and it is something that we keep a keen eye on in the deal space. And also, pivoting back to Frank's point with 100 shareholders, that is another benefit of partnerships. You're not subject to that limitation of having only 100 shareholders. And you don't see people pressed up against it every day, but it happens.
Okay.
Yeah, again, it's not. I couldn't put a percentage on how many that consideration would apply to. And again, that's another one. LLCs, as a general rule, don't have a limitation on the number of members they can have. But again, if you elect S corporation status, that's something you have to keep in mind.
Okay.
Yeah, and I think one last thing on S corporations is that the rule against disproportionate distributions, that's not just limited to economic distribution. Sometimes the IRS gets a little creative as to what's a distribution and what isn't.
Okay.
So say, Sarah has a Ferrari as a quote-unquote company car, and the IRS might step in and say, okay, what is this? What's going on here?
Gotcha.
And I say it half jokingly, but we've seen instances of truth is stranger than fiction. So.
Well, thankfully, I drive a Subaru, so I'm not driving a Ferrari. Also, probably should point out that I do not own an S corporation. Is there anything else that we should touch on the S corporation before we move on to our next designation?
I think one final thing is if there's some sort of transaction that you're running into that's not covered in the S corporation rules, then you look to the C corporation part of the code.
Okay.
So, for instance, there's nothing on merging two S corporations together. Then you look to Section 368, which applies to C corps. So
Okay.
there's a catch-all section at the end of Subchapter S saying, okay, if we didn't cover it here, go to Subchapter C.
Right, right. And that makes sense. Let's talk about the benefit corporation. I can't say that I think that really any insurance agency would fall under this level, but maybe if we can just do like quick definition, quick overview here.
Yeah, sure. I mean, I will concede I don't believe I've really come across benefit corporations or B Corps in my professional life, at least thus far. But generally, I mean, they are kind of exactly what they sound like. They are corporations, so they're formed by the filing of articles with the Secretary of State, in this case of the Commonwealth of Pennsylvania, but any other state really. And the big thing, I guess, that separates it on a surface level is B Corps have a stated public purpose that they serve. And contrasting them to a nonprofit corporation, they are allowed, I mean, B Corps are for profit, but they serve a public purpose at the same time.
Okay.
So, again, I'm not sure how applicable that would be to the insurance industry, but depending on what, you're trying to do with your business, it can be advantageous for you. Again, I'll defer to Justin on the tax side of things because I think that's where you get a lot of the benefits. But otherwise, I mean, as an owner, I think one of the more attractive points is that you get to serve a public purpose, which you would assume would be important to the owners. And it also will attract customers and possible future partners that are equally dedicated to that public purpose. So that is certainly a benefit. And the company is allowed to make a profit, which is the big difference, I think, between a B Corp and a nonprofit corporation.
Okay.
Yeah, I think, Frank hit the nail on the head pretty well there. So in my 10 years so far practicing, I've helped clients set up one B Corp.
Okay.
And I'm 10 laps in. You think of your Toms and your Bombas and your Patagonia. I think just there's the intrinsic value of the consumer thinking to themselves, all right, well, it's helping some kid out and who knows where. And But as far as from a tax perspective, there's no real benefit. The way I structured mine was an S corporation with the individual owners and then the nonprofit that we're going to talk about more in a second here. That was a shareholder in the S corporation.
Okay.
And so there was like a designation of, okay, as we discussed, with the distributions having to be proportionate, then there was guaranteed income towards the nonprofit. So, yeah.
Interesting. So good to know about the Toms and others. That's basically the one-for-one concept that you buy one and you're essentially donating one to someone somewhere in need. So let's get into the nonprofit corporations then and kind of look at the definition and requirements here.
Sure. So I've done, I guess I would say, somewhat limited work with nonprofits, but I think the real sticking point to the general public is that when it comes to nonprofit corporations, the money you bring in at the corporate level, it doesn't get distributed out to the owners or the members of the nonprofit like you would in any other for-profit business entity structure. Rather, that money goes to the operating expenses of the corporation, LLC, the nonprofit, which includes, general overhead, salary to employees. I mean, it's not to say that everyone that works for a nonprofit is a pauper or anything, but the company itself is not making distributions of profit. It is paying what it needs to pay to keep the lights on, and then it re-injects anything else it brings in to that stated public purpose. And Justin, I think a lot of the nonprofit space really kicks over to the Internal Revenue Code. That's where you see a lot of the laws surrounding it. I'll defer to you on that.
So everybody's heard the term C3, and so at the risk of stating the obvious, the reason it's called a C3 is because it's Code Section 501c3, and that's the charitable organization prong under that code section. And yeah, you just need to adhere to the formalities because, to Frank's point, like when you're a nonprofit, there are no owners. You have trustees. And one of my law school professors, she always emphasized that a better phrasing would be not for profit because these nonprofits can still engage in profit-making activities, and if it doesn't have anything to do with your charitable purpose, then that is on the chopping block and subject to tax with the IRS. And I think a great exemplification of that would be a cafeteria at a hospital. That has nothing to do with helping ill, injured people. You're just getting a grilled cheese or whatever.
Right.
And it's interesting because you see so much growth in this space over the years, and it could be its own episode unto itself, honestly. It's its whole world. It's a code section where there aren't just attorneys or accountants devoting their entire careers to it, but entire firms as well. So, it's to the extent that anyone wants to start their own non-for-profit, be cognizant of the fact that because it technically doesn't have any owners, dissolving a nonprofit is not as easy as it might seem at first glance. You need to find another nonprofit with a similar stated mission or charitable purpose and have all these filings with the Attorney General's office, at least in Pennsylvania. I can't speak to any of the other states, but it is not as straightforward as one would think at first.
Interesting.
Same goes for the deal space, too. I mean, you don't sell a nonprofit because then you'd be taking profits.
Right.
But there are, membership substitutions and things like that. And anytime we talk about that, you're looking at a level of government oversight that you wouldn't see in your typical M&A deal. So, again, to Justin's point, everything kind of changes when it comes to nonprofits. Similarities certainly exist there, and there are parallels. But the oversight mechanics, I think, are certainly much more robust than what you would see in another business structure.
Okay. I think we got into this a little bit before because I think just in my research that I did, you see this doing business as name, this DBA. What is the difference between the DBA and a sole proprietorship? Because it doesn't really seem like there's that much of a difference.
Yeah, it's sort of circular when you think about it. So many sole proprietors use DBAs. You are not required to have a DBA to have a sole proprietorship. And DBAs are not specific to sole proprietorships. Any business entity can register for a fictitious name or one of these DBAs.
Okay.
Again, the reason as a sole proprietor you might decide to do that is because, again, it changes the identity of the sole proprietorship, which is ultimately you at the end of the day. Again, I think the biggest thing is it adds that level of credibility, kind of separates you from the actual business, but without the onus of submitting all of the paperwork, maintaining the formalities to have another sort of registered entity. But again, as far as what is the difference, a DBA it's a legal fiction. It's a nickname, essentially, as a matter of law, that businesses or sole proprietorships can operate under. But you do not need to have a fictitious name or one of these DBAs to run a sole proprietorship. Many choose to do it, and it's not a particularly onerous process to get a DBA. You need to go on the state website, make sure that the name is available. But then the registration process is fairly straightforward. And I've come across it a couple of times. It's a little off topic, but when we were dealing with the Corporate Transparency Act, which was a major issue for just about every small business in the country until it wasn't anymore, a lot of people had questions about that, and they were sole proprietors with fictitious name registrations. And the key point there is that you were not then subject to that particular act because you've still not registered a business entity with the state, even though you have this business name.
Right.
You yourself are not a registered entity. So that's where I feel like I became more intimately familiar with the differences and mechanics of the DBA for sole props.
Gotcha. That was just recently in March that was all finalized, correct?
Final for now is the way I feel like I think about it.
Same.
But yeah, it seems to have gone by the wayside for most domestic corporations. Now, again, flipping back to the C Corp, the act is not gone altogether.
Right,
I mean, there are still implications for foreign business entities conducting business in the United States. So if you're a C Corp and you're a C Corp because you have foreign ownership, well, that beneficial owner might be subject to the CTA, and you might be subject at your entity level to CTA compliance as a result of that. So it is something to keep in mind. it's probably a non-issue for a lot of domestic business entities, but it's not fully dead, so to speak. So it's something to, again, keep an eye on. But you won't hear your attorneys and your filing servicers bringing it up to you anytime you form a new business, which you would have 4 months ago.
Yeah.
Right. Where did they land on the BOI reporting? Is that still something that LLCs need to complete, that they still need to go in and do that if they haven't already done that?
So
you can go ahead.
I think FinCEN, the enforcing agency, more or less threw their hands in the air, and they're just on standby until the Supreme Court issues a decision.
Gotcha.
I don't know if you have a different take, Frank, but...
Yeah, again, they issued interim final ruling saying that as of now, you can voluntarily file, but there won't be penalties for not filing your BOI reports. That ball is still up in the air, and we're all kind of waiting for it to drop so we can get some definitive answers out there. But I would say for now, it's sort of just everyone's holding their ground on it. Some people prefer to file. If you're smaller and you don't have that many beneficial owners, you might just elect to file to get it over with. Larger business entities that have a lot of subsidiaries, and then the subsidiary might be a beneficial owner of another company, and then who's the beneficial owner at that point, whose information you file. They might decide to hold off until they find out more, because it can be a significant amount of work to get everything organized. I think if you are feeling any anxiety about it at this point, what you can do is start gathering the information that you would need to file without actually submitting the filings, which, has a monetary cost to it.
Right.
You're certainly free to start preparing for it. And that way, you won't find yourself in a lurch where you have to scramble to get everything together. Though what I will say is that FinCEN was, at least to date, has been pretty remarkably kind about it. I think when the first injunctions came out against it, there was some concern that, well, this injunction could go away, and we were pretty close to what was then the deadline for filing on January 1st of this year.
Yeah.
So it left a lot of people wondering, well, what if this goes away December 29th? What do we do? And I believe it did like December 23rd or something like that before reviving that injunction. Again, the legal process here has been absolutely theatrical in some ways, I think. But FinCEN was pretty understanding, and they extended the deadline. So I can't speak for the Department of the Treasury, but we would hope at least to see that continue if there were further implications of CTA compliance for domestic companies.
Right. I would hope that they would give enough leeway of time, because they gave, from the first time I believe that they were talking about it, it was a good 7 or 8 months, because we had suggested that people go ahead, get it done, get it over with, and then just recently saw that, okay, no, this is not a thing anymore. And they are, like you said, being very forgiving as far as that they're not actively pursuing cases or anything against people who do not have that registration completed.
Yeah, for an agency that shares an umbrella with the IRS, they've been pretty gracious.
Alrighty, so we talked a little bit about how the DBA, you can have a DBA if you have a sole proprietorship. We talked a little bit about having the LLC with the S-Corp election. Are there any other ways that some of these different entities can kind of combine? Because some of them seem to serve as, yes, they are a business entity. Some are kind of more of like a designation. How do they intersect and intertwine in, I guess, ways that would apply to our industry? I would say we probably don't need to worry so much about the not-for-profit and the benefit side of things.
So it's too much to unpack in an episode, in this episode, and probably merits its own. But there is a whole subchapter of the Internal Revenue Code devoted to insurance companies and the insurance industry. There is certain different treatments for life insurance companies. If you check the box for certain small business insurance companies, you can have it where only your investment income is subject to taxation. And then there are other analyses where losses not accounted for are off the table. And like I said, just too much to get into in this episode. But I think there are a lot of other benefits out there. And since Frank brought up the foreign considerations, to the extent any of your listeners have foreign subsidiaries, they need to be very mindful of tracking their liabilities compared to their AUM, because if they have too much AUM and too little liabilities, they would be casted as a passive foreign investment company rather than a qualified insurance company, which it's much less favorable, to say the least. So,
Gotcha.
yeah.
Well, then I think we can probably move on to when we've made that decision that, okay, I have my insurance business, I want to incorporate in some way. What do I need to do next?
So there are a lot of similarities between all of the business entities we've discussed that do register. Everyone registers with the Secretary of State of your state. Most states, everyone that I've ever come across, including the Commonwealth here, has a dedicated corporation bureau that handles those kinds of requests and processing. And again, so with the LLC, what you're talking about is a certificate of organization or a certificate of formation. So there you're going to set forth the business name of the company. Part of that process, again, is searching to make sure it's available. And this is also, just as a side note, why we don't see as many DBAs for LLCs and S-Corps, C-Corps, etc. They have them, but a lot of people, they register the name they want to operate as. So there isn't as much of an imperative to get that fictitious name, though we see it. I mean, people, do decide to use it. As far as what you'll see on the articles, it's really a lot of basic information. It's going to request the location of the registered office in the state, which is not to say that you cannot effectively operate in another state or jurisdiction, but you need to have some sort of registered office within the state. In Delaware, for example, we typically see these registered agents used because Delaware is such a popular state for incorporation. That there's almost a whole industry of just people that go in and form your business form and use their address as the registered location.
Elon Musk.
Yeah, I think there's one building in Wilmington, Delaware. It's 9 floors, but it's the headquarters of like 5,000 corporations.
That is, wow.
Yeah.
Yeah, and that's your difference between your registered location and your principal place of business. Let's see, what else would we see on there? Not too much in the way of company purpose. Usually you would state your company purpose in your operating agreement.
Okay.
And what we typically see there is that you try to sort of give an outline of what your business does, but then some broad caveat language that would include anything permitted under applicable law, which gives you the freedom to expand, change your business without necessarily needing to go and get an amended and restated operating agreement or anything like that.
Right.
On the certificate, there are some check-the-box sections that you'll come across, what I would say are generally highly regulated industries: medicine, law, insurance. That's one that comes up. Or maybe insurance doesn't. I could be wrong on that. I might be confusing that with accounting. But again, that's just a check-the-box list that you would see depending on what business industry you're getting into.
And I would say, it's a little bit of a hot take, but I'd say the only real benefit to incorporating in Delaware these days is if, for whatever reason, if you'd anticipate having some sort of shareholder dispute, like a corporate proper legal matter, because then you're dealing with the Delaware Court of Chancery, not some random person who's never interacted with corporate law before in their lives. So.
Okay.
Yeah, I would tend to agree with that. Most of the benefit is, I would say actually that I think most states have sort of fallen in line with Delaware's general structure as far as governing statutes. But again, they have a court dedicated to business disputes, like derivative shareholder actions and things like that, that you would not have the benefit of that in Pennsylvania, for example. So moving on from the LLC, I think we've sort of hit everything there that you would expect to see on the certificate of organization. You wouldn't need to list the names and addresses of your owners or members, I should mention. The name of the incorporator or organizer is listed there. But ultimately, I would go so far as to say it's forming a business entity itself. Submitting these articles or their certificate is not the most difficult thing. The forms are pretty user-friendly and available. Again, that's not to say that I don't recommend speaking to somebody that's familiar with it. There's also filing services that handle a lot of the actual process of filling out and submitting for you. But that's just one aside, I guess I should mention. As far as the articles of incorporation for both S Corps and C Corps, and B Corps for that matter, because that's actually that's a check the box election that you make on the articles.
Okay.
There isn't a separate form for that. Again, you're going to set forth your business name. There's a statement that the company is formed in compliance with the Pennsylvania Uniform Corporation Act or law. And as far as company purpose, that's not going to be something you need to state or set forth on the articles. Again, the name of the incorporator is going to be on there, but the incorporator does not need to be the actual owner. Again, there are services that do this for a living. So you would eventually see a release of the sole incorporator as part of your normal housekeeping after all of the dust is settled from the formation process. Same thing with the office location. You need to give the location of a registered office. This does not necessarily mean that that's the only place you can do business out of, though a P.O. box will usually not suffice. So
Okay, good to know.
We frequently see people use their home address if they don't have some sort of physical brick and mortar space to call home for the business, just because P.O. boxes are easy enough to get, but the Corporation Bureau does not favor them when it comes to using them as registered addresses. I would say it's definitely adjacent to it, but you don't submit them to the Corporation Bureau. But for corporations, you have bylaws. Again, these don't need to be submitted to the state or anything like that, but I don't think we've talked much about them thus far. And really, your bylaws are sort of the cousin to the operating agreement in the LLC space. Their purpose really is to dictate governance matters for the corporation. So, number of shareholders, approval percentages for certain actions. And again, there is some flexibility. You can require a simple majority for one thing, but a super majority for, some high-level action like major disposition of assets or equity, things of that nature. Related to bylaws, it's not required, and I should also mention that bylaws are not required upon formation, but I don't think you'd meet any attorney that would tell you not to draft some.
Right.
Again, that's your corporate formalities to avoid veil piercing, and it all is very circular in that way sometimes. But what we also see in addition to bylaws are shareholder agreements, and these are contracts among the owners of the corporation which govern their relationship among each other. And this is where you would often find restrictions on transfer of individual shares, drag-along, tag-along rights in the event that a majority shareholder is deciding to sell. Can he make his fellow minority shareholders come along with the sale? Do they have a right to tag along with the sale, even if he, doesn't necessarily want them to, or the buyer doesn't want it all? That's where you would see those kinds of things dealt with among the owners of the company, whereas the bylaws, I think, they do touch on some shareholder items, like meetings, the annual meetings of the shareholder, which are required by law. It might set, some parameters for that, but I think by and large, the bylaws typically go towards more the directors of the company rather than the shareholders. Anything I missed there on the paper trail?
I think that's all she wrote.
I was going to say, I think you touched on, how you submit the information, where you submit the information. And I do want to just come back here and kind of spotlight it, that if we have a lot of people that sell insurance in states other than Pennsylvania, usually if you're licensed here in PA, you'll get your license in New Jersey, New York, Delaware, just the surrounding states, because you might have family members that refer other family members. So if I am registered with my business here in Pennsylvania, but I sell in all these other states, is there anything else that I have to do in those states that I'm selling in as far as my business registration goes?
Register, because we do have a client, they're based in PA, but they started operating in Virginia, and unbeknownst to them, it's been a nightmare for them. It still is a nightmare for them. And we're talking about, it's been 2 years now, and they're still embroiled with Virginia. So.
Oh, wow. Okay.
Yeah. In addition to complying with your industry-specific licensing requirements in those other states, which you kind of already mentioned, If you're going to set up a physical location in another state, you're going to want to file for a foreign qualification. The steps of which vary somewhat by state, but generally it's you putting that foreign state. And when I say foreign, I mean if I incorporate in Delaware, but I'm operating out of Pennsylvania, I need a foreign qualification for the Commonwealth of Pennsylvania. It lets the state know, hey, I'm here, I'm conducting significant or at least non-negligible business activities in your state. That usually goes hand in hand with filing for a state tax ID, paying state income taxes, sales tax as applicable, things like that.
And I think kind of bringing this whole conversation home plate, it might not be a bad idea to the extent you find yourself in a foreign jurisdiction and you're operating frequently to maybe set up another LLC there or whatever entity and have that be the subsidiary of your major holding entity or your primary entity.
Gotcha. So I think probably my biggest takeaway from any of this is that we generally advise our agents to work with a financial advisor if they are, in need of any kind of financial advice. We recommend partnering with other people who are experts in their own right, in their own fields. And kind of what I'm thinking here is that as we are, putting down these roots, putting things on paper, submitting them to the state, that really it is a good idea to have an attorney on file for your business, to have a financial advisor on file for your business. Is there any particular type of attorney that we would be looking for to help us with our insurance business? Like, say, I want to register my business. I want to have this person as the person I can go to with any legal needs, questions, whatever. What kind of attorney am I looking for?
It's an interesting one.
You're looking for Frank Lavery.
I don't know about that.
Is there a specific type of attorney, or is it simply just find a law firm and do that, like, outreach? This is what I'm trying to do. Can you connect me? Like, how would I go about doing that?
I think in a similar fashion to when I mentioned partnership rules are complex and you want an accountant who specializes in partnerships, you want somebody who knows enough about the insurance industry that they have a go-to blueprint for themselves and can give you sound advice that's been tried and true throughout the years.
Okay.
And somebody that sounds a little, corny, but somebody that you trust, because this is your business, this is your livelihood, and if you're going to take it off of the ground, you want to have somebody who's going to have your back and be in that foxhole with you. So.
Okay.
I think you had sort of alluded to it, but sometimes it's not just your attorney that matters, it's their firm as well. Because there are, general practitioners that kind of have an iron in just about every fire. But when it comes to, your more complex issues, it can really matter to the success of your enterprise to have a specialist that can be tailored to your specific need in a given instance. So, the attorney that you consult with and counsels you in forming your business is probably not, nothing's set in stone in any industry, I feel like, but you probably don't want to come to me if you get sued. You'd want to talk to a litigator over that. So, we have the benefit of working with a lot of different specialists in a lot of different area, and we're able to play off of their expertise. So, I think it's important to build a good relationship with your relationship attorney, but it's also important to understand what's the full scope of what not just that one attorney can do for you, but the firm as a whole.
Okay.
Yeah, there are all sorts of different specialists. If I'm having a hard time breathing, I'm not going to go to a neurologist. I want to go see a pulmonologist. So kind of similar. People don't often think about lawyers in that regard, but we have our own specialties. So.
Right. We might not think about it that way, but we should. Are there any closing thoughts that you had, maybe anything that you would like to mention that you feel like we didn't cover on this topic, however niche or broad it may be?
I think this was pretty comprehensive. Would have loved to have had this podcast to listen to when I was taking corporations law.
Yeah. Yeah, it's an extremely dense topic. There's a lot of information to go over.
Right.
And again, as Justin said, some of the things we touched on could be an episode of their own. So I guess, the last thing I would leave with is when in doubt, talk to somebody that, is able to help you and give you some sound advice on this, because it's a big decision for anyone to make when they go and decide to set off and start a business. So you want to make sure you get started on the right foot.
Right.
Oh, I think Frank said it perfectly. You want to know when to seek help and just go from there. And like I said, feel it out. Find some advisor that you trust, that you get a good feeling from them. Because again, it's your livelihood and your business, and you want to keep it going. So.
All right. Well, thank you both for coming in today and for sharing your insight with us. Really appreciate having you both on the show today.
Yeah, thank you so much for having us.
Yeah, thank you for having us.
Special thanks to Frank Lavery and Justin Abodalo for the interview. Now that you've made it all the way through, head on over to the notes for links to more episodes like this one. Thanks so much for listening. We will see you next episode. The Agent Survival Guide podcast is a production of Ritter Insurance Marketing, an integrity company. Special thanks to our guests, Frank Lavery and Justin Abodalo. Recording and production by me, Sarah Ruppel. Podcast designed by Urban Rivera. Artwork by Tina Lamoureux. Follow along with our show wherever you like to listen. Like what you hear? Follow along with our show for more.